You've just landed on House Lux Estate, your trusted guide in the world of successful investing. Here, we shed light on the enigmatic world of wealth and prosperity, revealing the secrets of the investment universe. We don't just talk about investing, we delve into the minds of those who've mastered it, the ones who've turned mere pennies into empires. At House Lux Estate, we believe that the path to financial independence is paved with knowledge and understanding. Our mission is to provide insights, to demystify the complex strategies employed by the world's most successful investors. Through our in-depth analyses and discussions, we aim to equip you with the tools you need to navigate the financial landscape, to make informed decisions that will shape your financial future. So, gear up for a journey into the exciting world of investments, where each decision can make a world of difference. Stay with us as we delve into the fascinating world of the rich and their investment strategies. The rich don't just have more money, they think about money differently. This concept is perhaps most evident in their approach to investing. Unlike the average person who often prioritizes the preservation of wealth, the affluent put a greater emphasis on the creation of wealth. This doesn't mean they are reckless with their assets. On the contrary, they are typically very strategic, focusing on long-term growth rather than short-term gains. The wealthy understand the power of compound interest, a concept that Albert Einstein famously referred to as the eighth wonder of the world. This principle is simple. The earnings from an investment are reinvested, which over time leads to exponential growth. This is no get-rich-quick scheme. It's a proven strategy that requires patience and discipline, but the rewards can be substantial. The rich also recognize the importance of diversification. They don't put all their eggs in one basket. Instead, they spread their investments across a variety of assets, including stocks, bonds, real estate, and even startups. This strategy helps to mitigate risk and increase the potential for high returns. Additionally, the affluent aren't afraid to take calculated risks. They understand that higher risk can lead to higher returns. However, these aren't gambles based on hunches or gut feelings. They are thoughtful decisions, backed by thorough research and analysis. Another key characteristic of the wealthy is their willingness to invest in themselves. They understand that their knowledge, skills, and experiences are their most valuable assets. Therefore, they continually strive to learn and grow, whether that means pursuing further education, attending seminars, or hiring coaches and mentors. In conclusion, the rich approach investing from a different perspective. They see money not just as a means to an end, but as a tool for creating more wealth. They are proactive, strategic, and patient, understanding that building wealth is a marathon, not a sprint. The rich invest with a long-term perspective, understanding that wealth is not built overnight. Let's take a look at one of the world's most successful investors, Warren Buffett. Known as the Oracle of Omaha, Buffett is the epitome of a value investor. His philosophy: buy undervalued companies and hold on to them for the long term. Sounds simple, right? But there's a bit more to it than that. Buffett's approach is based on the principles of Benjamin Graham, the father of value investing. Graham believed in buying companies that were trading for less than their intrinsic value. In other words, he looked for bargains. Buffett took this idea and ran with it, but with his own twist. He focused on understanding the businesses he invested in. For Buffett, it's not just about the numbers. It's about knowing what a company does, how it makes money, and whether it has a competitive advantage. He's famously quoted as saying, "Never invest in a business you cannot understand." This deep understanding allows Buffett to have a level of conviction in his investments that many investors lack. He's not concerned with short-term market fluctuations. In fact, he often says that his favorite holding period is forever. This long-term approach allows him to ignore the noise of the market and focus on the underlying value of a company. And it's this approach that has made Buffett one of the wealthiest people in the world. But it's not just about making money for Buffett. He's also a generous philanthropist, pledging to give away the majority of his wealth to charitable causes. It's this combination of shrewd investing and generosity that has made Buffett a beloved figure in the world of finance. So, what can we learn from Buffett? Don't be swayed by short-term market trends. Understand the businesses you invest in. Look for value and hold on to it. And perhaps most importantly, remember that investing is not just about making money, it's also about making a difference. Buffett's success shows the power of patient long-term investing. Another successful investor who has made a significant impact is Ray Dalio. Dalio, a hedge fund manager and philanthropist, is the founder of Bridgewater Associates, one of the world's largest hedge funds. His investment philosophy is unique, and it's this distinct approach that has contributed significantly to his success. Dalio places a strong emphasis on diversification. Unlike many investors who focus on specific sectors or markets, Dalio believes in spreading investments across a wide range of assets. This approach is designed to reduce risk and create a balance within the portfolio. It's about not putting all your eggs in one basket, so to speak. If one sector or market takes a hit, the impact on the overall portfolio is minimized. Risk management is another key aspect of Dalio's investment philosophy. He doesn't shy away from taking risks, but he is meticulous about managing them. For Dalio, it's not about avoiding risk, but understanding it, measuring it, and making informed decisions based on it. It's about taking calculated risks to maximize returns while minimizing potential losses. Understanding macroeconomic trends is also crucial to Dalio's investment strategy. He believes that to make successful investments, one must understand the bigger economic picture. This involves analyzing economic indicators, understanding market cycles, and considering geopolitical events. It's about understanding how these factors influence markets and making investment decisions accordingly. Dalio's approach to investing is not just about picking winning stocks or making quick profits. It's a comprehensive strategy that involves careful analysis, thoughtful decision-making, and prudent risk management. It's about understanding the complexities of the financial markets and making informed decisions based on that understanding. Dalio's investment strategy shows that understanding the bigger picture is crucial in making successful investments. His success serves as a testament to the effectiveness of this approach. It's a strategy that requires patience, diligence, and a deep understanding of the financial markets. But as Dalio's track record shows, it's an approach that can yield significant rewards. So, how can you start investing like the rich? The first step towards investing like the wealthy is to shift your mindset. Investing isn't a get-rich-quick scheme. It's a long-term strategy. The rich don't invest for immediate returns, but for substantial growth over time. They understand that the market is a roller coaster and they're in for the ride, not just the peaks. Next, knowledge is power. The affluent don't just throw their money into any venture. They invest in what they understand. So before you dive into an investment, take the time to learn about it. Understand its ins and outs, its risks and rewards. Knowledge will not only increase your confidence, but also your chances of success. Furthermore, take a page out of their book and diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, real estate, and even startups. By diversifying, you're not only increasing your potential for returns, but you're also minimizing your risk. Remember, every investment carries a risk, and diversification is one way to manage it. The wealthy also prioritize value over cost. They understand that the cheapest option isn't always the best one. Instead, they focus on the value an investment can bring to their portfolio over time. This doesn't mean you should disregard cost altogether, but consider the potential long-term value as well. And finally, the rich are patient. They understand that wealth accumulation takes time. They don't panic when the market dips, nor do they celebrate too much when it spikes. They stay the course, adjusting their strategies as necessary, but always with their long-term goals in mind. Investing like the rich is not about having a lot of money. It's about having the right mindset. So start today with what you have. Equip yourself with knowledge, diversify your portfolio, focus on value, and be patient. These are the keys to investing like the rich. We've taken a fascinating journey into the world of the rich and their investment strategies. We've uncovered the secrets of Warren Buffett's long-term, value-oriented approach. We've delved into Ray Dalio's risk parity principle and his diversification strategies. And most importantly, we've explored how you too can apply these lessons to your own investment journey. Remember, investing like the rich doesn't necessarily require vast sums of money, but a keen understanding of the market, a disciplined approach, and a willingness to take calculated risks. It's about making your money work for you, just as the successful investors we've discussed do. In the end, it's not about becoming rich overnight, but about growing your wealth sustainably and creating a secure financial future for yourself and your loved ones. Don't forget to subscribe to HouseLux Estate for more insights into the world of successful investing. See you in our next video.